Hello everyone, this is Teacher Karen. Welcome to Business Finance. Ang lesson po natin ngayon is the steps in the financial planning process. All individuals, professionals, businessmen will have their goals to be in profession or business. However, about objectives at business finance, we have to plan them. You should know how you can save a lot. You must know your goals. Here is the step-by-step financial planning process, which includes 6 steps in financial planning process which will assist you. You should be aware of the life cycle approach of financial planning process to structure your goals. The long-term goals that you plan to achieve in the future play an important role in everyday life as you already have in mind a set of plans for the next 5 years. If you are not yet sure what you want in 5 years from no will probably still have an idea of what kind of life you want. You are still in the process of planning. Planning is an important aspect of the firm's operation because it provides roadmaps for guiding, coordinating, and controlling the firm's actions to achieve its objectives. Management planning is about setting the goals of the organization and identifying ways on how to achieve them. There are 2 phases of financial planning. Financial planning starts with long-term plans, which would then translate to short-term plans. Okay. What is the difference between the strategic and the tactical planning? Long-term financial plans or the strategic plans are a set of goals that lay out the overall direction of the company. A long-term financial plan is an integrated strategy that considers various departments such as sales, production, marketing, and operations for the purpose of guiding these departments towards strategic goals. So meaning, ang strategic ay pagpaplano para sa long-term financial plans. Ibig sabihin, ang pagpaplano niya ay hindi lang pang isang taon. Maybe 5 years or more. So meaning, ang pinag-uusapan po dito is yung sales, production, marketing, and operation for their companies. So strategic goals. That is strategic. Strategy na gagawin nila para lumago ang negosyo. The long-term plans consider proposed outlays for fixed assets, research and development activities, marketing and product development action, capital structure, and major sources of financing. So, yan po yung kailangan nila consider for doing the strategic planning. It also would be termination of existing projects, product lines, or lines of business, repayment or retirement of outstanding debts, and any planned acquisitions. Short-term financial plans or the tactical plans specify short-term financial actions and the anticipated impact of those actions. So, meaning the tactical plans is for the short-term financial plans. Part of short-term financial plans includes setting the sales forecast and other forms of operating and financial data. This would then translate into operating budgets, the cash budget, and the pro forma financial statements. So in strategic planning, they plan about the strategy on their marketing, sales, production, etc. But here, in tactical plans or short-term financial plans, the other focus is about budgeting and the financial statements. Steps in financial planning process. Step 1. We have 6 steps. So step 1, determine your current financial situation. In this step of the financial planning process, you will determine your current financial situation with regard to income, savings, living expenses, and the debts. Preparing a list of current assets and the debts balances and amounts spent for various items gives you a foundation for financial planning activities. Step 2. Develop financial goals. You should periodically analyze your financial values and goals. This involves identifying how you feel about money and why you feel that way. The purpose of this analysis is to differentiate your needs from your wants. So, kailangan ma-identify mo yung needs and wants mo para mabago mo yung financial values and goals mo na kailangan isang tabi ko muna yung needs, isang tabi ko muna yung wants, uunahin ko yung needs. And then kapag may extra ka ng money at okay na yung status ng financial mo, siguro tsaka mo na iintindihin yung wants. But for now, for your financial values and goals, you need to differentiate your needs from your wants. Specific financial goals are vital for financial planning. So your financial goals can range from spending all your current income to developing an expensive savings and investment program for your future financial security. So yun muna uunahin mo, yung how to save and how to invest. So savings and investment program para for your future financial security. Step 3. Identify alternative courses of action. Developing alternatives is crucial for making good decisions. Although many factors will influence the available alternatives, possible courses of action usually fall into different categories. So, yung status ng buhay mo depende kung ano yung magiging decision mo. The categories are continue the same course of action, expand the current situation, change the current situation, take a new course of action, take. Not all of these categories will apply to every decision situation. However, they do represent possible courses of action. Creativity in decision-making is vital to effective choices. So siguro, minsan, ang decision mo, itutuloy mo yung plano mo or expand mo yung current situation mo or baguhin mo yung situation mo and then babaguhin mo yung bagong plano. Step 4. Evaluate alternatives. Kung may mga napili ka ng alternatives, may plan A ka, may plan B ka. So, evaluate mo sila. You need to evaluate courses of action, taking in consideration your life situation, personal values, and current economic conditions. So, depende kung anong sitwasyon meron ka. kung ang i-grab mo ba yung plan A mo o ang i-grab mo ba ay plan B mo. So, alam mo yung magiging kahihinatnan. So, kailangan mo siyang i-evaluate o pag-aralan. Consequences of choices. Every decision closes off alternatives. A decision to invest in stock may mean you cannot take a vacation. So, ibig sabihin, consequences, may mga decision ka na may hinaharap kang consequences. For example, kung mag-i-invest ka ng stocks, kailangan mo mag-hands-on, hindi ka makakapag-bakasyon. If your decision is to go to school full-time, may mean you cannot work full-time. Okay? Opportunity cost is what you give up of making choice. Decision-making will be an ongoing part of your personal and financial situation. Thus, you will need to consider the lost opportunities that will result from your decisions. Okay. Evaluating risk. In many financial decisions, identifying and evaluating risk is difficult. The best way to consider risk is to gather information based on your experience and the experiences of others and to use financial planning information sources. Financial planning information sources. Relevant information is required at each stage of the decision-making process. Changing personal, social, and economic conditions will require that you continually supplement and update your knowledge. Step 5. Create and implement a financial action plan. In this step of financial planning process, you develop an action plan. This requires choosing ways to achieve your goals. As you achieve your immediate or short-term goals, the goals next in priority will come into focus. To implement your financial action plan, you may need assistance from others. For example, you may use the service of an insurance agent to purchase property insurance or the services of an investment broker to purchase stocks, bonds, or mutual funds. Step 6. Reevaluate and revise your plan. Financial planning is a dynamic process that does not end when you take a particular action. You need to regularly assess your financial decision. Changing personal, social, and economic factors may require more frequent assessments. Reevaluate and revise your plan when life events affect your financial needs. The financial planning process will provide a vehicle for adapting to those changes. Kung kailangan baguhin yung plano, baguhin kung may nakita ka ng hindi magandang kahihinatnan. Okay, preparation of budgets. Preparation of budgets and planning the goal of maximizing shareholders' wealth must always be out in mind. Therefore, the following criteria must be used for an effective planning. Criteria for an effective planning. Specific. So, target a specific area for improvement. So, pag nag-prepare tayo ng budget, kailangan specific. Okay? Another one is measurable. Quantity or at least suggest an indicator of progress. Next is assignable. Specify who will do it. Next, realistic. State what results can realistically be achieved given available resources. Another is time-related. Specify when the results can be achieved. Okay. According to Kayanan A, 2015 said, a plan is useless if it is not quantified. A quantified plan is represented through budgets and projected or pro forma financial statements. Those budgets and pro forma financial statements are useful for controlling. They serve as the basis for monitoring actual performance. So, ang budgets o yung mga projected ninyong budgets, yan yung magiging guide nyo para sundin, para masunod nyo kung ano yung pinagplanuhan. Meeting the plans is good. However, failing to meet the plans is not equivalent to failure. If the reasons for not meeting such plan can be justified, especially when the reasons are fortuitous in nature and are beyond the control of management. Measuring actual performance. By advice, the plans given at the early starts of the year allows the management to assess the company's performance and come up with remedial action if warranted. Okay. How about the sales budget? Sales budget, this is how a sales budget formulated. The most important account in the financial statement is making a forecast of sales. To forecast means is to plan beforehand. Since most of the expenses are correlated with sales, the sales budget is formulated. Financial statement analysis. Discuss in your accounting subjects that cost of sales ratio, gross profit ratio, and the variable operating expenses ratio are based on the sales figure. Given the importance of the sales forecast, the financial manager must be able to support this figure with reasonable assumptions. So this is the formula for sales budget. Forecasted unit sales times price per unit. Total gross sales. So in external factors, we have external factors under sales budget, microeconomics variables. These are the GDP rate, inflation rate, and the interest rates. Among others, play an important role in forecasting sales because it tells us how much the consumers are willing to spend. Okay. That is the GDP, the interest rate, and the inflation rate. Okay? And then, a low GDP coupled by a high inflation rate means that consumers are spending less on their purchases of goods and services. Meaning, kapag mababa ang sweldo o ang budget ng bawat pamilya, that is our GDP, ibig sabihin, tataas yung inflation rate natin kasi walang masyadong bumibili dahil walang pambili ang bawat pamilya. Okay? So, that is GDP. So, habang bumababa yung GDP natin, tumataas yung inflation rate natin. So, this means that we should not forecast high sales of the periods of low GDP. So, kapag alam nating bumababa ang GDP, huwag tayong mag-costing o mag-forecast ng mataas na sales kasi hindi siya mamatch. Kasi mababa yung GDP tapos high sales ka, ibig sabihin hindi siya totoo. Kung mababa ang GDP natin, mababa din yung sales. Kasi konti lang ang bumibili. Katulad ng panahon ngayon natin, hindi masyadong bumibili ng mga hindi kailangan ng bawat Pilipino dahil mas inuuna nila ang mga essentials. Okay? Development in the industry. Products and services which have more developed in each industry would likely have a higher sales forecast than a product or service in slow-moving industry. So developments in the industry, consumer trends are always changing. Thus, the industry should be competitive to be able to appeal to more customers and stay in the market. We have also competition. Suppose you are selling bread and you know that each person in your community eats an average of 1 loaf of bread a day. The population of your community is 500 people. If you are the only person selling bread in your town, then your sales forecast is 500 units of bread. Kasi ikaw lang mag-isa. 500 yung community. Ang people o yung population ng community mo is 500. Tapos ikaw lang ang may karinderya. Kaya ang may bakery. And then, bawat isa sa kanila kumakain ng 1 loaf. So, meaning, ang ipo-forecast mo o ang i-declare mo na ang sales mo ay 500 units of bread. But, however, you also have to take account your competition. Kung 4 kayo, what if there are 4 other sellers of bread? You will need to have to divide the sales between the 5 of you. Kasi may 4 ka pang kakompetensya, hindi na lang ikaw yung may bakery. So, may ka-competition ka na. Thus, this means your new forecast should be 100 units of bread. So, ang tansyado mo, lagi i-forecast mo, ang benta ko sa isang araw siguro mga 100 units of bread na lang kasi 5 na kaming may bakery dito. You should also know the preference of your consumers. If more of them would prefer to buy more bread from you, then you should increase your sales forecast. Pero ang labanan dyan is yung lasa ng tinapay nyo. So kung mas maraming bumibili sa'yo, meaning pwede mo itaas yung sales forecast mo ng 150 or 200 units of bread. Internal factors, production capacity, and manpower. Suppose that you have already the microeconomic factors and identified that there is very strong market. For example, yung bakery mo, mabili, and then kulang pa sa tao. So, ang ibig sabihin, magdadagdag ka ng tao. More manpower, more production. So, you forecasted that you will be able to sell 1,000 units of your products. However, you only have 20 employees who can produce 20 units each. Your capacity cannot cover your expected demand. Hence, you are limited by it. To be able to increase capacity, you should be able to expand your operation. So, yun nga, kung kailangan mo ng tao, magdadagdag ka ng tao para mas mabilis yung production. So, there is an implication if sales budget is not correct. If understated, there can be lost opportunities in the form of foregone sales. So, importante yung sales budget. Kung ang sales budget mo ay kailangan mo mag-produce ng 1,000 units per day, so kailangan magdagdag ng tao para makakabenta ka talaga. Dahil kung hindi na masusunod yung sales budget mo. So, mahalaga po yung sales budget. So if it is optimistic, the management may decide to unnecessarily increase capacity or hire more employees and end up with more inventories. Production budget. What a production budget is and how it is formulated. It provides information regarding the number of units that should be produced over a given accounting period based on expected sales and targeted level of ending inventories. Kapag may order na at kailangan na siya for 1 week or for 2 weeks, kailangan na siya in 2 weeks, kailangan ma-budget mo yung production. Kung magagawa mo ba yung product na kailangan mo in 2 weeks. So, importante din ang production budget. Required production in units is equal to expected sales plus target ending inventories minus beginning inventories. That is the formula. Production budget is equal to ending inventories plus forecast sales units minus beginning inventories. Projected financial statements. It is a tool of a company to set an overall goal of what the company's performance and position will be for and as at the end of the year. It sets targets to control and monitor the activities of the company. Bali, ang mga financial statement na sinasabi po dyan is yung income statement, balance sheets, and the trial balance. So, kailangan ma-monitor yan kung umaangat ba o dumadami ba yung expenses o maayos ba ang financial status ng isang kumpanya. Here are the following reports that may be forecasted. Projected income statement, projected financial position, or the balance sheet or projected cash flows. Financial forecasts assist businesses in the attainment of their goals. They are the future prediction of finances which provides details of actual and the results or progress of performance. Predicting the financial future of a business needs a lot of consideration, especially if the business has not yet been established and has non-financial history. The forecasting and making adjustments will enable a business to become more precise and accurate in numbers in the future. How about projected income? According to Woodsey 2020, that is an estimate of financial results you'll see from your business in a future period of time. It is often presented in the form of income statement, although it does not have to be. How to estimate? Let's say the ABM supermarket is an expansion. You have to decide or you have decided to put together a projected income statement for the following year to see if the new products are dominating the market. This is the example for projected income statement. As you can see, we have 5 years. 2014, 2013, 2012, 2011, and 2010. This will be their projected income statement. This is the sample. This is also an example of projected financial position in 5 years. Okay. The balance sheet shows a business actual historical financial position, while a projected balance sheet communicated expected changes in future assets, investments, outstanding liabilities, and equity financing. Businesses may consider a projection of a balance sheet as to facilitate long-term strategic planning, which often concern future asset growth and how it may be supported by increased financing through both debt and equity. It provides the most relevant financial information needed in the business planning process. This is an example of projected cash flow. We have cash as a percentage of sales in 2014, and then we have projected cash in 2015. If you want to predict your business's cash flow, create a cash flow projection. A cash flow projection estimates the money you expect to flow in and out of your business, including all of your income and expenses. Let's practice. Production budget. So how do we compute it? In ending inventory units plus forecast sales units minus beginning inventory. Okay, we have here a table, year 1, year 2, and year 3. In year 1, we have sales in units 5,000, beginning inventory 1,500, ending inventory is 3,000. So how much is the production budget? So meaning we will add the forecast sales units, which is 5,000, plus the ending inventory 3,000, that is 8,000 minus 1,500 beginning inventory. So the total is 6,500. In year 2, we have 10,000 plus 5,000, 15,000 minus 2,500 is equivalent to 12,500. In year 3, 15,000 plus 7,000 minus 4,000, we have 18,000. So that is how to compute the production budget. So meaning this will be the budget for production department. So words of wisdom before I end. Money isn't about buying bigger and better things. It's about being prepared to take care of your family. Thank you. God bless and stay safe. Bye-bye. Until next video.